Hey, what is up, dudes and dudettes? This is Dudediligence here. Before you proceed and listen to this entire video or watch it, I want you guys' feedback on what kind of format you guys want this video to be like, or like the series to be like. So my plan is to record it and with like minimal visual, and you guys will see. The editing work is taking too much time. I'm kind of lazy. I'm just wondering if you guys just want to listen to this as a podcast, since everything is basically scripted, and you will just see my face and I will just talk about it, and then everything basically I will read it off a script like over here that you will see. Actually you can't see because the script is right here, and it will be really organized. We'll have bullet points and everything. That will be the super easy for me to put out because I don't really need, I only need to do minimal editing work. But the way how I'm gonna do this video is gonna require a lot of editing. It really depends on how many people actually watch those kind of content, and if not a lot of people watch it, I probably just doesn't care and just put out as podcast. But just tell me, guys, like comment down below and tell me what kind of content you want this to be like. Okay, and then in today's video we're going to do a general overview on the entire structure of the financial market. Okay, we're going to talk about the basics, the very basics of finance, and get you guys basically just started. Okay, obviously those are quite beginner content, but after you learn all of those things I'm going to cover in this series, you will be better than 90% of the entire retail population. And this is class 1 of a series, okay, of the series, and let's just get started. Also, this video format is going to be a little bit different from my other videos, like I mentioned before. I will try and make some edits and everything so that everything looks nice and see how many people actually watch it. And you guys should comment down below whether you just want to listen to this as a podcast, and I only need to make minimal edits in those places that we're just going to do it as a podcast situation. So let's get into this. Finance is, well, let's just say the science of building wealth, and wealth cannot be generally achieved without spending time. Okay, in other words, wealth building is an accumulation of funds over time. So wealth building is composed of two major aspects or components, as we will. First one being wealth generated by capital investment. Okay, aka using money to make more money, which usually involves in financial instruments or daily operations of a business. The second one is by labor. We offer physical labor, do some, I don't know, does massage count as physical labor? Or offering sort of any kind of service to others. But no matter which aspect of wealth building process that we are gonna be involved in, the trade-off is always time. And some call it opportunity cost, okay? But in a more financial world, we call it the time value of money. And then you have to adjust the trade-off of time value of the money, depending on whether it's better for you to spend time doing A or spend doing B. Maybe spend doing B will make you more money than spend doing A for a longer period of time. Or you can dissect both of them and sort of do a pros and cons and a SWOT analysis on both of them. I will cover all of that in the coming days of this course, okay? And we're probably gonna use a lot of stock market examples to explain a lot of those concepts and examples and circumstances and dilemmas of trading on certain things versus another things, or making some real life examples of certain things, and maybe use girls as an example overall. Okay, so for those of you who don't want a really practical approach to the financial market, and as we all know, nobody cares about the more definition-based, understanding of definition-based kind of classes. This is the equity financing class. We're probably gonna cover a little bit of corporate structure, but that's probably gonna be a separate course in a separate series, and we're not really gonna touch a lot about the labor side of the market. Okay. Because providing labor and service is kind of boring, okay? And plus no one is here to really hear me ramble about why physical labor and services follow a rather linear model which traps social mobility. In another way, it's not really a sustainable way if you want to get out of your social class. Like, for example, if you are like me, who's broke and who live somewhere poverty, and a lot of people on YouTube say I'm living with my parents, all those kind of stuff. I cry every day, and I can barely afford everything on the market, and then I cry every day on my bed and those kind of stuff. For people like me who want to get out of their social class, by purely working, there's no way you will achieve there. Okay, and in one of my master's thesis, I actually made a very compelling argument on why higher education will only stop you from reaching social mobility changes rather than actually help you in the long run. And what are some financial instruments that you can use to generate wealth, right? You might ask. The basic ones are stock, bonds, commodity, and other things, including derivative, and some might consider crypto. We will offer a crypto masterclass if this theory got views and a lot of people likes it. Crypto is actually really deceiving as an asset, or maybe not an asset at all. All of those. Just wait for that thing, because I have a very interesting perspective on cryptos and NFTs. I actually got a friend who asked me about whether getting paid in NFTs is a good idea or whether getting paid in cryptos is an idea. Generally speaking, general rule of thumb, and again, we're not financial advisors. We do not provide financial advice. We're only here for shits and giggles, and these are educational content and for entertaining purposes only. Okay. Generally speaking, when the market is down, crypto is a no-no. Okay. And as we all know, stocks and bonds and commodities and other stuff, they're all assets, right? And because those things are assets, we have to record them using general accounting formula. Basically, accounting, for those of you who don't like numbers or don't like all of these accounting shenanigans and tax shenanigans, what you have to know is accounting is basically just the language of recording business. And how the general accounting formula goes is asset equals liability plus owner's equity. An asset is basically what you already paid for that you can generate revenue with, right? For example, this iPhone, I didn't buy this iPhone. Somebody bought it for me as a gift. This iPhone is an asset. Let's just say we offer a telecom communication services. We help relay phone calls from one place to another, and then therefore a phone is like our principal asset of operation. We need phones to operate, basically connect phones to phones. Therefore, it's basically an asset we already have, and it helps us make revenue. Okay, and liability is what you need to pay in the future that will help you generate revenue. For example, a classic liability here would be, let's just say you hire someone to let's just say we run a massage parlor. You hire someone to do massages on your clients, and you have to pay them every single month, and those are payroll liabilities. But these people need to eat, and these people won't work for you unless you pay them in some kind of stuff. NFTs, favors, back in the mafia days, or shells, or US dollars in this case, or anything, or you know what I mean, like anything. Payment is payment, yeah. And equity represents everything that's basically the result of revenue activities, which including your previous revenue piled up, becoming net earnings or net income, and then you sort of issue the stocks that represents your general assets of the entire company, which then we're going to talk about enterprise value, but we're not going to get into this in the first course. Okay. And if we simplify the entire financial market, then we will be presented with sort of like an auction-like mechanics. And for those of the people online who are saying that the entire market is not really like an auction, they're basically wrong. In textbook scenarios or in investment banking, we always face with a sort of buyer and seller situation. If we propose a financial asset on a market or anything, basically, we trade. Basically, the entire financial market is a trading mechanism. No matter if it's a business, business is essentially, if you have something, right? If I want to buy, let's just say, a bottle of water from someone, the product exists. We have the process of producing that product, and eventually we have to put it on a market for somebody to buy it. And how would the price movement go? The more supply it has, and then pegged with demand. When demand offsets the supply, the price automatically goes up. When the supply offsets demand, then the price will drop. And when there are competitors flushing the market, then because in order to make people pick one over the other, and it's not really some high-end market stuff like Louis Vuitton, therefore price is basically the general revenue driver. Okay, so the entire financial market is basically like a trading mechanism. We buy low and sell high. And in this case, we buy low and sell high of using financial instruments that represents companies or just purely assets. Okay. And there are three major categories of this general market trading activity. The first one being speculation, second one being arbitrage, and third one being hedging. Okay, of course, but before we get into any of these, I think we're getting too long of the first introductory for us. We have to lay out all of the assumptions before we go in. Okay, next video, we're going to talk about speculation. Then the video after that, we're going to talk about arbitrage. And then the video after that, we're going to talk about hedging. And all of them is I will try to contain them in under 10 minutes for the ease of editing and for the ease of your ears. And I will probably make them into a playlist or a series. If you guys just want to hook up your phone and put it while you're driving or something, I will talk all about it using real life examples. So first of all, the first assumption we're making here is because we're trading generally assets that are businesses, right? We're trading, either any stock you buy on the market is essentially trading on the assumption of how much the underlying stock or underlying the underlying operation of the business is gonna worth in the future. Okay, like for example, PayPal. If you trade in PayPal stocks, and generally the market is acting in a way where you're betting on the upside. Therefore, you're basically saying that PayPal's the entire, if you combine all of PayPal's assets, including their business, including their people, soft and hardware powers in their company, we're using stock as a valuation mechanism to evaluate how much this company worth and a monetary value. Okay. And because we're doing business valuations, we assume that businesses intend to run continuously for long term. Okay, this is one of the biggest assumptions in the financial market where people do. And if you hear anyone use discounted cash flow or any of these complex financial algorithms or formulas to really decide how they evaluate the company's value, one of the biggest assumptions they make is called the perpetuity assumption, which generally just means that we often consider that business intend to run continuously for a long time. Therefore, in case of bankruptcy, it actually you will see that a lot of value is getting questioned because of bankruptcy. If bankruptcy happens, a lot of times people get really sad about it. Anyways, we're going to talk about that later on. Okay, so with that assumption, we assume that growth is normality of any businesses. However, we do acknowledge negative growth, okay? But we anticipate a correction to the problem, aka pivot toward a situation that will provide growth, which means let's just say for 1 or 2 years or maybe 5 years, you experience a negative growth situation in a company. The general market assumes that it's a temporary problem, but your price will adjust based on this temporary problem, and they sort of anticipate you to correct that in the following years, and you might produce a better growth because you experience a negative growth. Okay, and this assumption is the primary reason why stocks and other assets appreciate over time generally rather than decline. And second of all, we assume that our trading platform are fair to both the buyers and the sellers of these certain financial instruments or assets. Okay, trading platform we're talking about here is not being Robinhood or any other brokerages, including TD Ameritrade and the big ones, Fidelity and all those big ones, right? But the general exchange setup of the market, which is established by the market, regulated by the SEC, the general market condition, okay? This just means that the old Uncle Sam won't one day come in and just take all of your money or intentionally makes it harder for either the buyer or sellers to make money unfairly, okay? So the assumption is the US market is a fair market, that the government, the government is politically pretty safe or stable, and they're not going to come in and grab your money or make one side make more profit than the other side. Obviously, this might not really be true completely, but generally speaking, the US market is the most liquid and the most fair market in the world, okay? And if you are into statistics, I can provide you with one on all of the stock value or asset traded on the US market is about 110% of US GDP. Does that make sense? That means, there's no way that, the US market has huge credibility in the entire trading community or in the entire financial market. And third of all, this is this is basically the last one we're going to talk about assumptions. There are technically 6 of them, but the 3 of them are kind of important here for you to continue in this class. You have to understand the mindsets of investors or the mindsets of why market price certain things the way it is. And then the third one is there's always a true value on any asset, okay? But whether the market price of such asset will ever reach convergence to that value is subject to market and investor reactions. That means, let's just say the true value of GME is around $60, but because we have a lot of hype, the value of GME goes to $254. But we as investors or speculators or anyone in the market, we have no idea when this true value will become true, or like the market price of $254 will basically drop to the true value that we anticipated to be. Okay. This generally just means that you can always make money on anything as long as you can make sure that your understanding of the true value of the asset is better than anyone else, or even just better than one person who have the asset. So then you can buy low and sell high, or you can short sell the asset when you don't think that the true value will be realized on a higher note. And the tricky part is that true value changes as time goes, and then true value of today might not be true value of tomorrow. Therefore, it's an ever-changing situation, if you know what I'm trying to get here. All right, if you like those kind of content, smash the like button and subscribe. See you guys on the upside. And please let me know, give me some feedback of this video, because this is rather new. I'm basically teaching you guys the very basics of the financial market with a little bit of a twist and a little bit of my understanding of it. And I think it's way better than just reading off from a textbook and tell you guys, this is A, B, and C, calculate derivative this way. We're going to get into the more mathematical side later on this course when we have a solid foundation of understanding of the market. And I will demystify a lot of those stupid, the YouTube consensus on certain mechanics of the market and, market manipulation. But a lot of times it's fair game. The reason why retail loses is because most of us doesn't have an in-depth understanding of how intrinsically market works or why a market exists as it is. All right.